Here we go.
All right. Good morning, everyone.
Just a reminder, this meeting is being recorded. If anyone would like to sign up for public comment, you can do so in the chat. We have a full agenda and some of you have to leave early, so I am going to kind of rush through this. And
Can you promote Mike Rush? He's on the attending.
Yep, thank you. I was just gonna say Mike Rush is joining, so. Ready for
All right.
All
right, let's get started because I have a few people departing this meeting very at the, what is it, at 10 o'clock? Well, 10 o'clock my time. So at
9.
All right, let's go. Welcome, everyone. I just want to do our opening statement. The trustees of the Boston Public Library reaffirm our commitment to racial equity and to principles of diversity, equity, and inclusion more broadly. The library is formally committed to becoming an anti-racist organization in response to systemic racism, inequity, and injustice prevalent in our society. We acknowledge also that the Boston Public Library's Central Library stands on land that was once a water-based ecosystem providing sustenance to the indigenous Massachusetts people, and it's a place which has long served as a site of meeting and exchange among nations. We are committed to land acknowledgements for all locations at which we operate. We reaffirm this commitment to set the context for our planning, deliberations, and public engagement so that we take this place from the spirit of welcome, respect, found in our motto, free to all. Pamela, can we do a roll call, please?
Yep. Arana Ortiz.
Present.
Bob. Najee. She is here. I'm looking at her. You're muted, Najee. Hyler is not here. Hawkins.
Yeah.
Leonard.
Yes.
And Rush.
I'm here. Can you hear me?
Yes.
Okay, roger that. Thank you.
Thank you. All right. Can I get a motion for the approval of the minutes, please?
So moved.
Second?
Second.
Second.
Thank you. All right, thank you very much. All in favor?
Aye.
Any opposed? Any abstentions? None. Motion passes. All right. Fleet. Let's talk about the fleet.
Thank you. We had previously asked to delegate the fleet award to the Finance and Audit Committee due to timing constraints. Just recently in the last week, we had to clarify a specification bid that was included in the packet. In order to make sure that all of our bidders have sufficient time to respond to that, we actually kicked it out a couple of weeks. So what we would like to do, if it's agreed by this board, is to actually move it to the full board meeting on February 4th. We anticipate that the total cost of the fleet is probably in the $350,000 range, which would be something that would be recommended to the full board regardless. But we just wanted to make sure, given that this is a public bid, that we gave everyone enough time to respond appropriately.
No issues there. Anybody has a concern? No concerns. All right, so we're moving this contract for full board for voting.
Thank you. The other item that was supposed to be flagged here as well was the audit. So our 3-year audit contract is currently up. We do have the option for a 2-year renew, or we can go ahead and open up an RFP for the next audit cycle. If anyone has any questions.
So so we're gonna do the RFP, Emily?
It's up to the committee. We have an RFP in the beginning of its draft stages, but we do have the option for a 2-year renew as well.
Any strong opinions from the committee, one way or the other? Wow, you all very silent today.
I think this is the first cycle. This is the first cycle with this firm. Is that correct?
This is a new firm. The last contract was awarded to a new firm, yes. I think that was the comment last time. Sometimes it's nice to have fresh eyes, or at least get some fresh eyes through the RFP process.
They started what year?
Make me do the math. Their first audit was for FY22.
So they're only doing it for a couple of years. I would propose an extension. Anybody? Has any questions about that? No?
Makes sense.
All right. So let's just, they've only been since 22, so that's only 3 years. So yeah, I'll just do an extension.
And Emily, if you wouldn't mind, the accounting team has been pretty happy and not had any issues in working with the firm. Just want to confirm that as well.
Correct. There haven't been any challenges on our side. It is primarily it's remote work right now. We're not meeting with them as much in person, but I think that's a trend. But no issues on our side.
Thank you.
Okay. All right, so let's extend it for another year. All right, do you want to do the votes first and then the budget, or the budget first and then the votes?
I would love to shift the budget to the end, if that's all right, just so we can get through the vote cycles here.
Okay, well, it's not really the end. Before Sebastian's we've been rushing Sebastian through. So let's
Jay,
go
can you
through the
I'm
votes.
sorry, one quick thing, Evelyn, Jay, can you please upgrade John Heiler for the record? He is on, he's called in. And also, I just wanted to acknowledge that the chair of the board, Ray Lou, is on this meeting as well.
All right. All right, let's go through the votes. So the loading dock, the concrete repair.
Yeah, so this is the next phase of the loading dock repair project. You probably remember the majority of it took place in the spring and summer of 2024. They identified additional deterioration of some of the structural concrete that we need to go in and repair now. So this is that portion. And the vote here is not to exceed $80,000.
Any questions about the loading dock repairs? I'm gonna have a vote for the lot, so I'm not gonna go each individually.
Perfect.
So any questions around the repairs? So how much is left on the repairs, Emily?
This is a separate contract. So they found additional deterioration that we needed to resolve. So this is a second contract that will be out, and we're saying up to $80,000.
Now, Jeet, you gonna say something?
No, it was the same question you had, sort of. So this feels like it's the remaining thing, or do we think other things might come up?
Right now, this is the remaining thing.
Okay.
We'll be set. You never quite know what you're going to find when you're in there.
Of course.
If this hadn't had such a disruption on operations at the time the first phase was being done, first major phase was being done, we probably would have tried to get a vote and roll straight into it. But it was very disruptive, as it
I remember.
the AC system to be offline, and so that's really why it's disconnected from the overall major repair. And there is opportunity within the shoulder season to do that with more minimal disruption this time around.
Great.
Okay. Dual camera book capture. Is this the camera that you put the book? It has it just takes the 2 pages.
Has a cradle, exactly. So it's a specialized digital camera. This is a sole source purchase simply because there's only one vendor that has the high res camera coupled with the cradle that we need. So this is for high value, high interest items that actually can't withstand being opened all the way to be digitized. So that's why we need this particular cradle and the height of the camera. High value, high interest items. I think the special collections team has already identified 1,000 things that could be digitized with this piece. And let me see here, the purchase cost for this is $179,015.37, and it would be funded through LLC.
Question, is this to replace one of the ones we have, or is to acquire a new one?
It's to acquire a new one. So it's all about this cradle. It provides you with more height to fit items into, and it doesn't require the items to be laid flat. So some of our high value older items, they simply can't withstand being opened fully.
Okay. Didn't I see, don't you have one of those already or no?
Jessica is on. If David is, I don't know, familiar myself, but.
Because I toured that area and it's pretty impressive. So, and I've seen how how they're scanned. That's why I'm asking.
Yeah, I think certainly what just while Jessica comes on to clarify, I think as the team has built out its expertise and capacity, and we just continue to increase our specialty skills, having particular specialty equipment for particular objects and items. It's now not just like 3 giant camera stations that we support, but a variety of ones that can be used for very, very discrete services. It is, Evelyn, I agree, it's incredibly impressive, even at this point, almost 10 years later. And I think we should actually offer a tour to any of the trustees that haven't been there yet, because it's an incredible part of our service operations today. So I think this is more about adding. Jessica's on now, so she can talk specifics.
Hi, everyone. Thanks so much for letting me speak to this question and for considering this request. And yes, to follow up on David's comment, we would love to have you come in for a tour and to see all the studio space. So our request for this camera is based on, yes, Evelyn, we do have the rare book setup, which I think may be the one that you saw. And this is a workstation that allows us to image books that only open to 90 degrees or up to 110 degrees. It's time consuming, and it's actually quite expensive to image books that way, which is one reason why we reserve that workstation for things that are either, for instance, like medieval manuscripts or things that are very high value, we really want to minimize any potential for damage. So last year we did a service analysis and we looked at all of our workflows and our workstations and what we were capable of doing. And what we identified is that we have this gap in our service. This is both for BPL and for statewide digitization. That does not allow us, we don't have right now the means to do these items that perhaps open to 110, or they're fragile, they have a lot of these other sort of care considerations, to do these items and to do them in a way that's cost effective and at the scale that we really need to be able to do this in. So rather than say 200 pages taking multiple weeks, this will allow us to do 200 pages on these kinds of items within, 60 to 90 minutes. So we'll be able to really, for special collections, Emily mentioned Jay Moshella and the other members of the team up there, they've already basically identified 1,000 items that they would put on carts and send to us right now if we had the capability. And we know that's just kind of the beginning of not only what BPL holds, but what our statewide partners hold. So this really does open up a new service and a new workflow, and really lets us make a lot of items that people care a great deal about and have great research value available to the public through digitization.
All right, Jessica, now you open the door because this is finance and audit and you said it's a new service. So when we have, people from around the state or whoever asking to digitize, do we charge them for those services?
No, so the statewide digitization program is entirely funded through LFC. And so we allow basically any statewide institution, any cultural heritage institution in the state can submit a request for these services. Our statewide team goes out and assesses them to be sure that they are something that we can do, that we have the capacity for. And if they are selected, they come into EPL for digitization and all the work. And that is all funded through LFC.
Can you say what LFC is?
Oh, I'm sorry. That's the Library for the Commonwealth budget line.
Okay. So question. Now I have a question. So as we are forecasting possibly budget cuts, because I'm always worried about budgets, And that's a line that we have seen incredible reductions through the years. Have we ever done sort of an analysis of what services are provided to the Commonwealth versus what we receive, so we're not on the red?
I would hand that over to David and Emily to address. I'm not,
Yeah,
I think
no,
they'd be able to speak more to that.
No, I get that. Can you
think-
guys put that on the queue?
Yeah, I think, I mean, I can give you a quick answer, but I think to do a proper service to the core question here, we should give a breakout to the extent that we can. There are some, of course, services within this area. All credit to Senator Rush as our elected representative on the board and the state funding that we get from our colleagues statewide. But there is certainly funding that supports services that are offered to Boston organizations that are indeed, I mean, Boston is part of the Commonwealth, so there is some disambiguation here that would be difficult to fully do, but we'll get back to you with a full report.
Yeah.
And David,
No,
to that point, if I could jump in, for years we've went away not too long ago, but the Library of Last Resorts, am I correct in that?
Library of Last Recourse evolved to
Recourse,
Library for the
yes.
Commonwealth
All right.
program. Yes.
So there's always an opportunity on the state level to try to get some more funding because there's an educational opportunity to my 199 colleagues to let them know that BPL is currently and has historically gone above and beyond to ensure their municipal libraries across the entire state are able to do the job they want to do. And we've done that. I mean, that's just historical fact. So.
No, and I would extend thanks to you and your colleagues for, despite the major cuts years ago, recent budgets have continued to increase even as times get tighter. One or more of the 9 library lines in the state budget that support not just BPL but our colleagues across the state. So we remain cautiously optimistic, but I do think under the guise of hoping for the best and preparing for the worst, we'll do the analysis that Evelyn has asked for.
And that to that point as well, we should communicate sooner than later because we want to make sure all of our libraries, particularly Boston Public, but all of them across the state are well funded and doing the job they can do to make communities better. So
Appreciate it.
Thank you, Senator. All right, this is really helpful. Any questions in regards to the dual camera?
No, Evelyn, you really asked the questions that I had, especially it's really helpful to know that this resource will be available to other institutions in the Commonwealth. I think that's wonderful. But no further questions from me.
Thank you, Nikki. All right, let's see if there's no questions.
Next up,
Next one. I have one question. The total amount of the contract is just for the camera. Where does that include a service contract?
Yes, Evelyn, that does. That includes the camera, the workstation, the service contract. There's, I believe, 3 years of maintenance. It also includes training for staff. So we'll have digital transitions in to help us set everything up, get everybody trained, and then keep it running.
Okay, great. Excellent. Thank you. Thank you, Jessica. You've been great. All right, next. Sorry.
No, that's okay. We have an IT service renewal. So this is licensing for data storage and backup over the next 3 years. So this total, the 61,670 is the 3-year total. And this is for large file items that just aren't appropriate for the cloud.
All right, so can I get, or is it Keith? Is Keith my man?
Can you open Keith's microphone? We only have the staff on, so if we have questions for them, I have to call them out to have them opened up
Yep.
individually.
Yes, may I answer a question?
Yes. Hi, good morning. How are you, Keith?
Good morning.
So, good morning. So what level is this on when you say on-site file storage and backup platform? Talk to me a little bit about that.
Sure. So BPL has a variety of file storage systems, primarily for daily office files that is actually handled through our Microsoft 365 subscription and the OneDrive and SharePoint file storage that we get with that subscription. This is licensing and storage space for hardware that we host on site at our data center at Central that is used for large media files primarily, as well as for backups of all of the servers that we also host on site at Central. So our integrated library system, for example, Polaris, is hosted on servers that are physically located in Central. We perform daily backups of the data on that and all of the other servers that we run. They go on to a Cohesity storage area network. And then those daily backups are replicated offsite to other storage so that we have an offsite copy in case there is a major incident at Central that would destroy the integrity of the on-site backups. So this that is one of the purposes, is for storing the daily on-site backups. It's large storage files there, as well as for large media files that are primarily generated through digital and online services for the digitization program that support Digital Commonwealth. So those files are not appropriate to store when they're scanned in the Microsoft 365 storage, which exists in servers in the cloud. Instead, they're stored on faster large block storage on site, and then processed and uploaded for access to the Digital Commonwealth. So this is a renewal for the licensing and space required to support those two different types of file storage.
So the services, I think I heard, it also includes disaster recovery.
That is correct.
And then do you all do disaster recovery testing at least once a year?
We do. We are actually in the process of changing our business continuity plans to make them more robust, changing providers in that area.
Okay. All right. I would love to hear once you guys have it. Thank you so much. Any more questions in regards to disaster recovery and backup solutions?
No questions from me. It's Nevjeet.
Anybody? All right, sorry. All right, Grub Street.
Similar to past years, this is a contract with Grub Street that provides adult and youth writing programming throughout the system. So the contract itself is up to $100,000. The plan right now does not reach that limit, but it's the way that the contract is written. So we would be paying them based on the programming that's scheduled.
I'm familiar with Grub Street. Any questions regarding Grub Street? Okay. All right.
Next, have some security equipment for the central library. So this is in response to one of the investment items that the library was awarded from the city operating budget for this fiscal year. It is for, let me see here, 35 cameras, 21 card readers, the badge readers for our IDs, and a network video recorder. All of them would be here at the central library. A staff assessment was done to identify gaps both in staff and item security throughout the building here. So this is included in our city operating for this fiscal year. And the total is $143,229.82.
All right, I'm gonna have people ask questions. I'm not gonna ask questions. Najee? Anybody? No? Okay, I have questions. So are these are replacement cameras? Are there additional cameras? Are there?
Additional cameras and additional badge readers as well. So you all have been here. Instead of having keys for doors, we're able to have electronic badge readers for staff to access certain areas of the library as well.
Okay, got it. All right, we don't have it.
Before you go on, I'm so sorry. Ray, can you please ask your question for the group? Because it has to be documented on we can't do it just in a chat. He asked, out of curiosity, do we have cloud backup? That was for Keith.
Keith,
David,
Yes, so the question was cloud backup.
yes, do we have cloud backup?
Yeah, yes, we do have cloud backup. So in multiple fronts. So our standard Office documents are hosted on Microsoft 365, OneDrive, and SharePoint, and those are also backed up with a separate service. We then have this on-site Cohesity backup storage system, which takes local backups, as I said, of the servers that we host on site, as well as the digital repository files that are in the processing stage. Both of those are then replicated to a local cloud backup storage provider called Wasabi. And so we have multiple copies there online. In addition, the production files for Digital Commonwealth are hosted on Microsoft Azure, but those are also replicated to a second cloud storage provider. Does that answer?
Thank you.
all right, thank you, Keith. All right, and then we have the next one is a recommendation for the full board, right?
Correct.
Okay, so let's take a vote on these first. So can I get a motion to approve, please?
So moved.
Second?
Second,
All right, all in favor?
aye.
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 Any abstentions? Any nays? No. Okay, motion passes. All contracts approved. And then the next one, it's a recommendation to the 360 contract to be delegated to the full board. Can I get a motion?
So moved.
So moved.
Any questions? That's sort of like kind of understood what it is. Any so moved. Okay. Wait a second. So moved. Okay, all in favor? I
Aye.
didn't know where I
Aye.
was.
Aye.
Any abstentions? Sorry, I lost my train. Any abstentions? Any no's? Okay, motion passes. Okay. Budget.
Are we gonna do any PC now and budget at the end?
Oh yeah, all right, I'm sorry. Budget. I mean, NEPC. Sebastian, you're on the docket.
Good morning, everyone. I will try to be concise in my comments just to move things along. But we have two things for you today. One is a performance update through November. We don't have the December numbers yet, but December was a softer month, so we should expect that performance pulls back a little bit, but on the whole, if we actually move ahead to slide 3, on the whole, it will be a very positive year, 2023, for the portfolio and the performance of the fund. A lot of data on these pages, but if you just focus on the top part of the page, you'll see the trailing performance, calendar year to date through November. The fund is up 10.4 versus 11.6, and I'll touch on what's driving a little bit of that performance differential there in just a moment. For the trailing 1-year period, up over 16%. And as you can see, as you head out to the 5 and 10-year periods, a good strong outperformance both on an absolute and relative basis. We ended off November with about 71 or just north of $71 million, so good strong investment earnings. There were some funds pulled for spending throughout the calendar year, as you can see reflected in that middle chart. And from an asset allocation perspective on the bottom left, you can see we're generally in line with our long-term targets. So the one actionable item that we have for you today is sort of a continuation of the discussion we were having last meeting, which is looking for options to replace the UBS emerging markets equity strategy that we have in the portfolio. If we move to the next page, a little bit more detail on performance here. I'll focus your attention again down the year to date, which represents the calendar year to date column. But if you're interested in what the fiscal year returns are for fiscal 25 through November, you can see up there that we're north of 6% through November. So again, we're likely to pull back a little bit in December, but strong performance throughout. So if we're looking at returns through 2024, what drove performance in the equity side? Mag 7, Mag 6, we can call it whichever number we'd like, but those companies generally continue to perform quite well, all else equal throughout 2024. And any pivot away from those names generally hurt performance given how narrow the market was. And any manager who leaned into those names generally was able to capture some of those returns. So large cap growth and specifically the AI technology focused names were the leaders throughout 2024. So when you look at performance here, what you'll see is that Diamond Hill, who's more of a value focused and value oriented manager, relatively speaking, underperformed simply because they don't hold exposure there. But it's something where we're comfortable being a little bit more diversified than just the market, because the market trends do shift. And we have seen heading into this year a bit of a broadening in terms of what's driving market performance. So wanting to balance that out is quite prudent. On the international equity front, Ernest has done a very good job for you over time, providing good diversified core exposure to the non-US space. And we'll talk about Halo separately here in just a moment. But they've continued to struggle a little bit in their performance. Halo is a very concentrated emerging markets manager. So think about somewhere around 30 or so securities in the portfolio. So stock selection is the preeminent driver of performance here, both good and bad. And you can see that they've had some struggles in terms of the performance historically. On the global equity front, we have two managers. Generation was funded last summer and has really started off with a good clip of performance. If you look at that since inception return, up 7.6%, slightly behind the benchmark. Impacts, on the other hand, has struggled this year. And if you recall, Impacts is a very impact-oriented strategy. The specialist strategy is very focused on the UN SDGs, very focused on investing across, things like water and solar investments, renewable energy transition, things that are more forward-looking in terms of what's to come from the transition perspective. So what they will not hold is some of the legacy or some of the drivers of returns that we've seen that I've mentioned. For example, in the MSCI ACWI World Index, about 18% of that index or the exposure of 18% of that index are the Mag 6 or Mag 7 companies. The specialist strategy will hold none of those companies. Partly by design, simply they don't want to follow the traditional path for growth, but partly by structure, where this fund is actually a little bit more small and mid-cap oriented, so they won't hold those mega cap stocks. Over time, this fund has done extremely well for you, double-digit returns, but there will be periods like we saw in 2024 where there are some headwinds to their performance. On the fixed income side, we've got solid returns from your managers. Generally speaking, outperformance across the board. This part of the portfolio will be a little bit challenged in December and a little bit in January as we've seen rates back up, i.e. increase over the most recent period. That said, that type of environment also makes it a little bit more attractive for them to invest as they're going to be investing in securities that are earning a bit of a higher yield. So very, very balanced positioning for the portfolio throughout. And then lastly, the all asset fund, this is meant to be a diversifier for your portfolio. The all asset fund by its name invests in many different asset types and is meant to be sort of a completion, if you will, to a strategy such as yours, in that they will invest in a lot of diversifying asset classes that we don't have on a standalone basis, where they're able to really add value through positioning, through allocation, et cetera. So on the whole, very good news. Performance has been strong. Very pleased with 2024. The one manager that they have some concerns with, we'll be talking about potentially new options today, which is UBS, and I'll touch on that in a moment. But with all that being said, I'll stop there just to see if there are any questions on the fund or any of the managers.
No, I guess Sebastian, just going out. I don't know if you guys can hear me or not, but Sebastian, just going
Yes.
out, the outlook for, there's a lot on the horizon that could throw. Anyhow, there's going to be a lot of volatility. Are you guys feeling that in the markets going forward, or do you think it's play out as a more kind of stable type of environment, or do you see it just as a lot of different things that could throw this market and the economy off?
A lot of different things. Definitely some uncertainty, definitely some volatility. I don't expect, while we expect the market overall to have the potential to continue to have positive returns, that won't come without some variability throughout. In addition to just sort of the political scene in the US, there are obviously situations that are happening globally as well. So the US was not alone in terms of the election cycle last year and this year. That's been a global trend that has continued to occur. Clearly, some of the rhetoric from the new administration in regards to taxes, tariffs, et cetera, can have an impact on growth, inflation, but also some of the regulatory aspects could actually boost growth as well. So all that being said, the expectation is that we should not expect to see a benign environment. However, I think on the whole, there is some consensus that the positive growth that we've been seeing can continue into 2025. Various parts of the market will probably be impacted a little bit more than others. So we're actually having we have an internal offsite that occurs every year where, John, we talk about exactly what you just asked, right? What are the opportunities? What are the risks? What should we be thinking about? How should we be talking to clients about positioning or rebalancing, any tactical ideas, et cetera? One of the ones that we will be talking to you about when we sit down just to review asset allocation is sort of just the geographical exposure that we have on today, and thinking about how we should best implement the exposure, really both near and long term. We've always believed that the MSCI ACWI is sort of the right benchmark to determine how we should be allocated globally, simply because it's representative of the global opportunity set. If you expand that to look at the MSCI ACWI IMI, the Investable Market Index, which includes small cap, what you'll see is that over recent periods, the US has grown in terms of the representation in that benchmark, so closer to that 66, 67% of exposure. EM markets and non-US markets have reduced in terms of that exposure. So generally speaking, we want to use that as a guideline as to where we think we should be positioned. So you'll hear a little bit more about that from us heading into 2025 at a future meeting. But those are the areas where we think structurally we should be focused on. On the fixed income side, it does look like we're in it for a higher for longer in terms of rates, and potentially inflation just sticking around a little bit higher, more elevated than the 2% the Fed would like to see. So the positioning that we have on, which blends both yield seeking as well as high quality, especially tips, real yields are kind of attractive today, all else equal, is appropriate from our standpoint. So not a ton of change there. So I know it's a long-winded response to your question. There's a lot to unpack throughout this year, but I think overall the positioning that we have incorporates many of those themes. And when we do review asset allocation, it's likely to be minor adjustments to the targets or to the allocations as a result.
Great, thank you. Yeah, I mean, I guess basically it's there's two sides to this that it could go either way, honestly. I mean, with inflation numbers, there's so many things that can throw this off, that's all. And we're going to do the best we can to be allocated in the market. I wouldn't be surprised if we went for a little bit of a ride. And if we're not, then that's great. But I just want all of us to be aware that this could be a pretty, if not next year, there's going to be some prices to pay for kind of the way the markets are right now. And I'm just always nervous about the global issues that are facing us. But the U.S. has been resilient. So again, it gets back to, when we talk about emerging markets or global or international, the U.S. has been a pretty resilient market. And I think that's got to be something we got to think about over the next few years as well.
Yep. Yeah, that's exactly right. And I think, when we, again, foreshadowing when we do talk about asset allocation, I think what you'll hear from us more so is leaning more into the U.S. And being a little bit more neutral outside of the U.S. today.
Okay, thank you.
Absolutely.
All right.
Great. So if there are no other questions, we can move over to slide 6. So as you recall, we talked about this at the last meeting, but just to kind of refresh memories, UBS is a core emerging markets manager who is quite concentrated in nature, again, around 30 securities. So stock selection is quite paramount in their process. If you look at their performance over the last number of years, they've struggled at some of the stocks that they've selected. Unfortunately, they faced headwinds, whether it was the sizing, whether it was the geographic location, whether it was the thesis. It didn't necessarily work out to how they would have liked performance to have transpired. What's happened over that time is that they've seen some AUM decline. That's been a combination of performance and withdrawals to the tune of about half the fund. So I think the fund today has somewhere in the neighborhood of about $5 billion. So still sizable, but less than where it was before. The main PM early last year retired. So someone who has worked with him or has stepped in as a new PM. And really the first thing that he was tasked with was taking a look at the process to see if there are any adjustments that need to be made. Today they're sort of in the process of making some of those adjustments. So if you look at the opportunity set in emerging markets, it's largely in Asia. So they've been bulking up the team in Asia to make sure that they understand that opportunity set and how that impacts their fund and their exposure. They want to look at how they're looking at securities and whether they should move on from them sooner, et cetera. So a number of enhancements that will take some years to play out. However, over that time for investors, as you're waiting for that, clearly the ride has not been as smooth as you like. So for us, as a standalone allocation, UBS, I think is great as within a pairing, but I think today as a standalone allocation, it might be a little bit add a little bit too much tracking to the portfolio. So what we wanted to do was take a fresh look at some options within emerging markets. It's not a space that we want to necessarily move away from. Yes, there are nuances that we have to be aware of, but we also want to be able to take a look at opportunities and managers where These managers can act as a good standalone core allocation, try to be balanced from a style perspective, try to be balanced from a size perspective, and provide a nice complement to the rest of the fund. So we've profiled for you 5 managers. We've listed them here. I'll go through them at a very high level. You'll see a lot of, or you'll hear a lot of overlap in terms of how they approach things from a very high level, but then the process themselves are very unique to each of these managers themselves. So Acadian, well, before I do jump into that, are there any questions before I start? I'll spend 30 or 40 seconds on each manager, and then we can chat through them.
Question, Sebastian.
Mhm.
Are we saying, so right now in UBS Halo, we have 3.6 million. So it's
Mhm.
just to move the entirety of that
That's correct.
onto a new manager? Okay. All right.
Yep.
We're not allocating any more, just likes for likes.
Like for like at this moment. Yep.
Okay. Got it. Okay. Thank you.
Of course, and that's a great question. So what you'll hear that's common amongst all of these managers is each of these managers incorporates some level of top-down and bottom-up in their process. Not surprising. You want to be able to understand the country dynamics that you're investing in before you select the securities that you want to implement the portfolio with. And I think one of the things where you have such a bottom-up stock-focused manager that may get a little bit lost in terms of that macro point of view. So John, to your point, understanding the dynamics in Southeast Asia and how that impacts opportunities in India or other parts of emerging markets is extremely important, and should at the very least be part of the discussion when you're making a stock selection decision. 2, because of the universe or how large it is, many of these managers will use some type of a quantitative screen. In most cases, the screen is simply used to cull the universe down to a subset of securities that match the characteristics they're looking for, and it's more manageable in terms of their ability to do research on those underlying securities. So it's really a 2-step process. And then 3, what you'll see is that these managers all have slightly different variations in terms of the risk they're willing to take on. So what that means is how different they're willing to look than the benchmark, how much tracking error, i.e. how much more risk than the benchmark they're willing to take, and the number of securities that they invest in order to get there. And when you'll see the numbers here, the ones that have a significant number of securities tend to lean in a little bit more on the quantitative process, whereas those who have fewer securities will be more fundamental bottom-up type stock selection managers. So starting with Acadian, Acadian is a well-known quantitative manager that has been in business for the better part of the last 40 years. They have a singular process for all of their strategies. It's a quantitative multi-factor stock selection model that they use that they've built over time. So late 70s, early 80s, they have a library of factors that they're looking at in order to build a portfolio that they think will outperform over time. Generally speaking, all of these factors fall into 4 categories, but they're expanded within there. It's valuation, growth, quality, and technical factors around the market, around securities. So I think the first 3 are very simple to understand. They don't want to overpay for securities. They want to have sound growth from the securities that they're investing in. Again, they're looking to balance this portfolio, not necessarily have significant style or size tilts. They want to have quality securities. So quality management, quality cash flows, quality franchises that could withstand volatility and perhaps protect on the downside. And then the technical aspects of how the sectors, the countries, the industry fit into the process. What this means is that they build a portfolio that is exposed to or looks to factors over a 1 to 3 month time frame, and they're constantly reviewing those factors to make sure that the portfolio is optimized to the right level to meet the return goals that they have. Which for them is that they're looking to over time outperform the benchmark by about 2 or 3%, 2 to 300 basis points over a 3 or 5 year period. And if you look at performance, which we'll bring up here in a moment, they've done that. They've actually had a stellar year this year. The unique thing about them is because of their process, they hold approximately 400 to 900 securities, and that varies over time. And the reason they want to have that level of diversification is if you look at the market cap that they're investing in, the securities that they're investing in, this is a truly all cap manager. So they will have some smaller securities, which we've seen actually a lot of opportunity in. And they'll be generally market weight on the larger or mega cap side. So a very well balanced portfolio. RBC, and if you have it in front of you, there's some more detail manager pages behind these, but RBC is a little bit different in that this is more of a bottom-up manager. However, this manager is one that is looking at the top-down themes that they think will drive market performance across countries and industries. It doesn't necessarily factor into a decision around a country weight, because ultimately some of that is from the bottom up portion, but they can't ignore the factors that may be tailwinds or headwinds within these regions, simply because that could be a big driver of performance. You know, if you look at China, for example, over the last year, a lot of headwinds, real estate, et cetera, where the governments had to step in to really provide liquidity and provide growth, and we saw really a pop in performance in the fourth quarter. But beyond that, there are some struggles that you have to be aware of. So for a manager not to look at that top-down macro could be erroneous if they didn't factor that into where they want to invest. So for them, this is a very high-quality manager, significant ESG factors, sustainability, et cetera, that go into the process. They look for strong management, quality franchises, and sustainable growth over time. So very high quality cash flows. It's a way for them to be able to really protect on the downside moats around these companies that they're investing in. You know, slightly different in terms of the number of names they bring to bear. They're looking to invest across 40 to 80 names, but stylistically, this is probably one of the best core options in the emerging market space out there today. They've done a very good job balancing growth, performance, and downside for their investors over time. William Blair is the third manager here. William Blair is a quality growth focused manager. So this is one of the only managers of the five that has a specific stylistic bet. So Acadian can tilt a little bit value. RBC can tilt a little bit growth. William Blair is very much growth focused. So similar to the other managers, they'll use a proprietary screen to rank based on quality, growth, and earnings trends, as well as valuation, to get the universe down to where they want to find the right names. And they look at three characteristics for names. They call it emerging growth, they call it sustained growth, and expanding growth. Emerging growth, not surprisingly, are up and coming managers. These are managers that they think have significant growth potential over time, but there are risks with that. So this is part of the segment. Oh, sorry, was there a question?
No,
Okay.
I was getting a question over here. Sorry.
Oh, sorry. Well, if the person wants to know a little bit more about William Blair, I can help them here too. But the emerging growth style, it tends to be the smallest piece because there's going to be some tracking to that, right? These are companies that, you know, perhaps it's a product, perhaps it's a business line, perhaps it's something that they want to bring forward, but it's sort of future-oriented prospects versus something that's already in the market and mature. Which leads you to the second, which is exactly those types of companies, sustained growth companies. And these are companies that have high cash flow, high return on invested capital, really the industry leaders in terms of growth companies in the space. And then expected or expanding growth is the third style, which are companies that are in the middle part of the growth trajectory. So it's sort of, if you had a line chart, if you will, or a line graph, you know, you sort of have your sustained growth are your companies that tend to be less risky, all else equal, earning you a nice 10 to 15% growth rate. Your expanding growth are sort of the next, the middle part of the line chart. You know, this is where the majority of this portfolio will be. You know, these are the sort of 15 to 20% growers over time. So sort of the NVIDIAs of the world, if you will. And then you have your emerging growth. So this is the smallest part of the portfolio, but the ones who have the potential to provide the largest growth share in the portfolio. Because this is an all cap strategy, some of the smaller cap names will fall into that emerging growth category. The strategy will hold approximately 120 to 175 names. It's struggled from a performance perspective over the last year because, unlike the US, one of the interesting factors is that value has actually driven performance in emerging markets and not growth. So the quality and the growth factors that William Blair actually pursues were a little bit of a headwind, as that was not what was being rewarded by the market in 2024. The next two are actually similar, but different flavors of one another. Very not systematic, but very constrained strategies in terms of these managers, Schroders and Fidelity, and I'll take them in tandem for you, really look to not deviate too much from the benchmark. They want to be within plus or minus either 5 or 10% of benchmark sectors, countries, et cetera. So these can be viewed a little bit as benchmark plus type strategies. Schroders has a global platform. Schroders is a very well-known name. They have a global research platform, so this team can leverage that platform for different perspectives, for different data, et cetera. The manager will utilize a top-down quantitative screen for country exposures. So they look at things like valuation, growth, risk, momentum, and base their country weights on that. So it's actually kind of a unique process where they rank all of the countries that are available to them to invest in, and they have a neutral set, which are set at benchmark weights, and the ones where they think have the prospects for higher growth or more attractive characteristics, they'll increase the weight to, and then the ones that don't, they'll decrease the weight to. So it's a bit of a systematic process in terms of how they get the top down. The bottom up is fundamental research, is what they're looking to fill the portfolio with. The one nuance about this strategy is that it is probably the most expensive of the 5. It's about 100 basis points, where the others are fairly well below that. So just a little bit of concern is, given how diversified the fund is, it's about 90 to 130 securities. Will that hinder a net of the ability to outperform, which they try to have a couple hundred basis points of outperformance over time as well. And the performance has generally been in line with the benchmark through recent periods. Fidelity, on the other hand, similar story. You have the Fidelity research engine behind it. Again, those similar risk constraints, they want to have a portfolio of about 100 or 125 names. Whereas you see that quantitative approach that I mentioned with Schroders, Fidelity focuses on their Fidelity research team to provide the names that go into this product. John Chow is a portfolio manager on this, and he works with approximately 20 or so analysts for stock selection decisions. From there, he'll look to make sure that the portfolio ultimately that's put together meets the characteristics that they're looking for, which is generally in line with the benchmark and quite constrained. So this fund is more or less 5 plus or minus 5% in terms of what they're looking to have exposure to from a stock selection, from an industry, from a sector perspective, et cetera. So very risk constrained, if you will. Pamela, if you're able to just go to that one slide that I sent a little bit earlier, just to put performance of all the strategies together. So we were able to run it through November.
Was that the add-on slide that you sent this morning?
Yeah, yep.
Jay, can you slip to the last one?
Yes, there we go. Thank you. So here's the performance track record, and apologies for not getting this sooner, but we were able to get the returns through November here for you. And this is my lack of technological ability. I was trying to move the benchmark to the bottom of the page, but it's right in the middle. So if you look at that pink bar and we just follow the pink bar across the top half of the page, what you'll see is managers that had either no real style tilt or a little bit of a value style tilt performed extremely well. So if you're looking at that blue bar across all of these time periods is Acadian. That diversification, that quantitative approach has done extremely well for them, and it did extremely well in 2024. That said, only caution here is that I don't have a concern that Acadian can continue that ability to outperform. They are the hot dot, right? So as history says, reversion to the mean, we always like to look at those managers who've outperformed, and we are disappointed soon after because we see performance sort of normalize. So only word of warning on that one, but generally speaking, Acadian has been able to do this over time. So that's where I have comfort in their ability to add that value. RBC is that red bar, and what you'll see is that in periods of down markets, so i.e. if you look at over the last 3 years, over the last month, if you will, they've been able to protect on the downside. So that 3-year mark, if you look at the 5, 7, and 10-year, that red bar outperforms that pink bar overall period. So that's just goes back to the consistency of their performance. William Blair, from a growth perspective, over the last year, great performance over the last 3 years. You can see that this manager is going to be the most active. So if the growth factors aren't in favor, you're going to see a little bit of a pullback. But once you get beyond that to the longer periods, that process has worked out as we've discussed. And then you have the yellow and the dark blue line, and that's Fidelity and Schroders. And you can see that their performance generally kind of aligns. You know, there are some periods where Fidelity outperforms, there are some periods where Schroders outperforms, but they're more or less in line with the benchmark, and that's a bit by design, right? They're not looking to take on too much tracking. They're not looking to really take on significant bets in the portfolios. That's not how their portfolios are structured. So with that said, what we did want to do for today is, one, obviously walk through the potential options here, but two, think about next steps. And traditionally what we've done is we've had a review like this and we've interviewed a subset of these managers. And I think that's probably the prudent approach here. So it's a matter of how we would like to approach this. In my mind, I have a subset of managers that I think are right for interviews. Not surprisingly, Acadian and RBC might be 1A, 1B in this instance. But the third is, do we prefer to see a manager for a third option that's a little bit more risk controlled in a Fidelity or Schroders, or someone who's actually looking to be a little bit more growthy or more return generating in William Blair? And that's where
Sebastian, I think that's the bigger question is do we want this portion of the portfolio, since we have so many other things that are tied to benchmarks? Is there one part of the portfolio, and it's we could say it's a smaller portion of the investment portfolio, but it's still really critical and important to the library? But is this where we do take some growth opportunity and look at a little bit more riskier part of the portfolio and go with someone that really doesn't hug the benchmark, but really may add some alpha and some performance? And I think that's the question I think we probably have, Evelyn, internally, is do we want to add a little bit of juice to the portfolio and do it here?
I mean, John, I think that if I understand your question correctly, like if there's one area in the portfolio where you would choose to be a little bit more risk tolerance, this should be it. As long as we're not backing away from our overall more conservative long-term constraints. I guess for Sebastian, my question would be, I agree with this analysis and with John's question actually, but is there a way to look at who is most volatility resistant? Because I know you've given us a 3-year and a 7-year look back, but the next period, based upon our earlier conversation, suggests we might have some volatility there, particularly as it comes to global markets. So is there a way to weight any of these managers as being a better choice? And could that drive the choice of the third candidate if we all agree that Acadian and RBC are certainly two candidates at this point?
Yes. So the two that are actually the most, that would generally provide you the most downside protection, simply through sheer diversification, is Acadian for one, and through process is RBC. So their process is
those are the two already that are already
exactly that are designed. I think with Schroders and with Fidelity, you have risk controls in place, but you will move more in line with the benchmark than others simply because of their structure, right? They want to have that exposure to all of those areas, and that's by design. It's meant to limit tracking, but you are going to have a wilder ride, or I shouldn't say a wilder ride. The ride is going to be more like the benchmark than perhaps some of these others. So, I mean, to answer your point, I think, on the one hand, you have RBC and Acadian as really the very good core standalone options. They happen to also be the two that can provide that downside protection. Then if we're looking for a third option, and it sounds like, you know, there is some appetite to look at an option that will look for that growth, will look to add that value, then in that case, that would be William Blair.
Sebastian, is there any down? I mean, other than time, is there any downside to having three?
Downside?
Yeah, I mean, obviously, it's just a matter of time, right?
Yeah, I mean,
adding the
it's
third
a
person.
matter of time. The nice thing about this, Jeff, is that all three are so different in their approach. You know, you won't necessarily hear the same story 3 times, right? So it's getting a good cross section of style and approach here, and how they all go about it is very different in terms of ultimate process. So no, I don't think there's any downside. If we were to look at a fourth, I'm not sure there would be too much value to have a fourth here to interview. But I think 3 is probably the right sweet spot.
Yeah, I agree with that. And then just Sebastian, remind me, I remember we looked at RBC the last time around.
Mhm.
I can't remember why we passed on them. Was there a change in PM? I can't remember why.
You know, there was not a change in PM. I think one of the or a number of the attractive factors that UBS provided is when we were looking at this, it's gonna be 5 years ago at this point. 5 years ago at this point, so think June 2019. This is pre-COVID. You're looking at what opportunities are out there. Given the concentrated nature of that strategy and the outlook at that point, some of the same areas that are actually headwinds today were the tailwinds 5 years ago. So being more in China, being more in that region, seeing that growth, that was coming from that market was something that UBS was attractive for, because that's where a lot of that exposure was in these singular names. I mean, in fact, if you think about 5 years ago, I mean, we were perhaps not at this table, but many clients were having conversations about having just dedicated China-only strategies added to their portfolios. That with a very strong performance, the previous PM had been on the strategy since inception. The fees of the strategy, I believe, were something in the neighborhood of 60 basis points or so. All those things were very attractive for what we were trying to do here. Pair that with everything else in the portfolio where we do have, you know, either just index strategies or managers that may not necessarily be looking to take on huge amount of tracking. There was a good fit there. Fast forward 5 years, unfortunately, some of those same traits are some of the same reasons that the managers underperformed. So.
Yeah, that's that makes sense. I now remember that, and I think that goes to Hyler's point of trying to predict which way this is going to go is probably a fool's errand and should inform how we think about looking at these 3 guys going forward.
Yeah, but I think it's a valid question, right? I mean, ultimately, you know, how are they thinking about incorporating the macro factors, which all of them are, which is what you want to hear. How willing are they to be different than the benchmark? I think that's an important one as well, because that informs, you know, how under or overweight they are to some of the top countries. So if you look at the MSCI index, MSCI Emerging Markets Index, the top 4 countries, so China, Taiwan, India, and South Korea, make up north of 65% of that benchmark. Right, so you have to be mindful of where you are from an exposure perspective and where you're willing to not be relative to that benchmark. So I think all those things factor into this, and I think each of them will have a slightly different viewpoint on that structuring and what it means for their strategies.
I mean, I think if there's emerging consensus based on your analysis that Acadian and RBC are probably the top 2 choices for a little better, you know, risk exposure, but not in a way that is, you know, diminutive. I don't know that is there value in adding William Blair, or would we get more value from a process point of view of having the more conservative one just to show up the contrasts in our interview approach. And Fidelity on your other chart appears to have a very slightly lower fee cost price point.
That's a good question. I think there is enough of a differentiation there to where Blair could make sense.
Okay.
Because they're not ultimately they're not trying to just be a core manager. You know, their process, what they're trying to do is build growth. So they are focused more on the growth aspects of the market. So I think there's a differentiation there for sure. Looking at a Fidelity or Schroeder, I mean, we could certainly consider that because that's different than any of the other managers, but from a constraint perspective, right? If we're interested in hearing from a manager that we know won't deviate too far from the market, then I think it's worthwhile at the very least hearing. But from the conversation, it doesn't necessarily sound like that's sort of the way the committee wants to go. I think there may be a little bit of interest in hearing it, but I think ultimately there's a little bit of consensus that if you're going to be active in emerging markets, you want to try to add value over and above that benchmark.
All right, so we selected the three?
So I think Evelyn, based on the conversation, if okay, the recommendation from our perspective would be to interview Acadian, RBC, and William Blair.
Yeah.
Yeah.
Sounds good to me.
Yeah. All right. Decision. Thank you.
Great. So we'll work
And then we'll
on timing, etc.
Okay. Yeah. So we'll figure out. Yeah. So we'll figure out the timing. Work with Pamela to see when we can do those interviews.
And Evelyn, would it be okay, Sebastian, if you talked, or is there anything you could do to help us a little bit on whether we want to be more aggressive in this part of the portfolio? And is this a good place to add the alpha? Since you're going to be in a volatile asset class, to kind of go a little bit more aggressive for the fences and just explain what that means, or how much it could affect positively or negatively our risk, on the portfolio. That's all. I think it would be helpful because this could be a place we want to be a little bit more aggressive than hugging a benchmark.
Yeah, so this, I looked at, this represents the 3.6 million, represent 5% of our portfolio.
Yep. Yeah, and it's, I just want to be mindful of time. I think you have a couple of other items before 10 o'clock, but.
Oh, yeah. Sorry, go. Well, not now, but maybe before we go through the interviews, maybe there's.
Yes, exactly.
Yeah.
We can do it, but you're right. Yes, Evelyn, it's 5%. It's a smaller part of the portfolio. So it's a smaller part of the portfolio. It's less efficient, meaning that there are a lot of the companies may not necessarily be tracked as other parts of the market. There's a lot of levers to pull by these managers to be able to add value. So generally speaking, when you look at emerging markets, or you look at small cap, or you look at credit, i.e. High yield, what have you, these are areas where, all else equal, being a little bit more active or a little bit more taking on a little bit more tracking can pan out. But you have to be comfortable with the fact that that may come with both ups and downs. So the goods can be very high, the bads can be very frustrating. But over time, that can pan out to performance that's, as you see here with the green bars, that is quite attractive relative to the index and on an absolute basis.
Okay. All right. More to discuss.
Yep.
Thank you so much, Sebastian.
Of course.
All right. Before I lose any other members of the committee, Emily, can we do a quick run through the budget, please?
We can. Jay, this is back up at the top of our slide deck. So just yesterday was the deadline to submit the maintenance budgets for city operating. So we sent everything in late yesterday afternoon, and of course overnight there was a change to it. So I'm going to go through how these numbers have shifted already. What you're seeing on the screen right here is our actual submission. So it did come in at a 1.7% decrease over the appropriated for this current year. The primary factor in that was that the utilities line wasn't fully calculated. So there's a couple of budget lines in maintenance that city inputs itself. We noted it in our budget submission to them. We know that it was low, but we submitted it as we could. So we submitted yesterday at a 1.7% decrease. If we took FY24's actuals for utilities, and this is what we described in our memo to the city as well, it would actually put us at a 1.6 increase. So the increase there primarily is salaries, as well as some other contracts that we have coming up that will have increases for this coming year. Overnight, the city went in and did adjust the utilities line and actually increased it $2.5 million. So currently, their numbers as of this morning have the library at a 3.4% increase. So probably a little bit high on the utilities line, honestly. The salary increases that we spoke about, and then the contract renewals that we have coming up, it's for MEP, security, and the elevator contract. So these, our budget submission yesterday also shows increases in those lines as well. Any additional?
Emily, sorry, just on the, I don't think I fully understand the utility point. What's the, is there a practical implication to us? Does it matter if it's outside of our budget and
We don't have a whole lot of
under?
Right, you're absolutely right. We don't have control over that figure. We have seen over the past few years, they're budgeting high. The city overall, there is quite a bit of volatility in how much is spent month to month on utilities. In past years, when they budgeted high, we've been able to ask, you know, hey, could we use some of the overage on, you know, paying for books or paying for overtime costs? So the fact that their numbers are coming down a little bit doesn't give us as much wiggle room in our maintenance budget. Where they have us right now is just about 3.9 million. Our FY24 actual was just about 3 million, so it's still a little bit high, but it's not going to throw us off that much.
I think my question was just way more basic, which is whether that's included in the budget that you're showing, or whether the city is sort of calculating it off to the side. Does that affect our ability to use overage for something else?
It does. So the numbers that you're seeing on the screen right now are lower than they are this morning. Right now, the city, the updates that they have created, the FY26 submitted has changed to 51.5 million. So this 49 is already a bit obsolete.
Got it. And therefore, if there is benefit in the utilities, we can use that money, or we can request to use that money in different places.
Correct.
Got it. Okay, thank you.
Okay. Anybody, anything else? Emily, it sounds like it's going back to the old process where we do maintenance. Is there anything new and different this year?
They'd asked for us to focus really on a level funded budget. So submitting a maintenance budget that really only included the contract changes. A couple of the pieces that we included in our maintenance budget, we did go over quickly the Microsoft 365 contract vote for today. We included an increase in our maintenance. Microsoft has transitioned libraries from an academic pricing structure to a nonprofit pricing structure that really skyrocketed the library's costs for contracts moving forward. Because it is a contract and it's an increase to a contract, we thought it was appropriate to include in our maintenance budget. But we're looking at an increase of about $175,000 just for the Microsoft 365. That is here, as well as I think we submitted 15% increases for the security, the MEP, and the elevator contracts. The other piece that was added into the maintenance budget is the book line. So I know we're always talking about the books and materials purchases. We have a requirement based on our state aid funding. In order to receive our full funding, we have to spend 12% of our city operating budget, the equivalent of 12% of our city operating budget on books and materials. So we added an increase to that line here as well, trying to make up some of the deficit.
Okay. All right, next.
Next slide is just an update on the capital project submission. So 14 items in total right now that have been documented. These are all still in conversation. So now that we've submitted all of our documentation, again, it was just yesterday, we'll be meeting with the OBM team probably in the next 4 or 5 weeks to go over in more detail on all of these items.
Is that it?
That's it.
Okay, all right. Any new business? No? Any public comments, Pamela?
There is none.
All right, excellent. We adjourn. Thank you so much. This was a packed meeting.
Yep.
Thank you.
I appreciate your
Nice
participation.
job.
Thank you so much, all.
Thanks, guys.
And
Great job, Evelyn, as always. Cheers.
Just a reminder that the full board is, was moved to February 4th. It's at the Honan Alston Library. Just to let you guys remind you that it's in person at 3 p.m.
okay,
With that,
all right.
Awesome.
thank you for calling in.
Thank you all.
Appreciate it.
Bye.
Thank
Bye-bye.
you.